episode 13 of Top of Mind. It is January 6th, 2023, and we are kicking off the first episode here of 2023. And on today's episode, we're going to discuss markets. We're going to get really, really bold with everyone, and we're going to make some predictions for 2023. And we're also going to review the 2022 year and just give some color and commentary and thoughts on what all happened last year. And lastly, we had a question come in on ETFs. And so we wanted to answer some clarity around inverse ETFs and some other sort of interesting ETF things that are coming out. So thanks for your question, listener. All right. Hao, over to you, sir. How are things? Let's get it started.
Well, Happy New Year. And yeah, things are going great. So it's 10:30 Pacific time on a Friday trading day. So looks like the markets are rebounding pretty nicely to, after a pretty rough start to the year.
Yeah, market's up. Tesla bounced off 100 a share earlier today. Hopefully that's good news for everybody. So yeah, the first couple of days were not awesome, but we're just getting started here.
Yeah. Just a few trading days in the year. You can't,
a few trading days.
Yeah, pin a whole year's worth of performance on a week.
Exactly. Well, why don't we start off with this ETF piece, and then we'll dive into our predictions and the 2022 year in review. So ETFs, there were a couple things that we wanted to cover from last time. You want to just discuss at a high level those items, then we'll dive into them.
Yeah. What we didn't get to, I know we broke down the bare basics of indexing ETFs versus mutual funds. The ETF world has definitely exploded in terms of the types of offerings, and levered ETFs, active ETFs, inverse ETFs, single stock, defined outcome ETFs are heavily marketed to investors, especially retail investors. And we just want to, briefly talk on some of these offerings here.
Yeah, thanks. And the question that came in was specific to levered ETFs. And this is actually a great question because we see this in accounts often. For those of you that are clients, you have our portal where you link up accounts that aren't directly managed by us. And so, we have the ability to see the holdings. And we commonly see these funds drop into there. And then we commonly, you'll know when you get an email from us like, hey, don't buy this thing. So levered ETFs is where we want to start. And then some of these other sort of newer inventions that have come out recently. So levered ETFs, why don't we start just with a description of what is a levered ETF?
Levered ETF is just that. Excuse me. And it uses a position and it levers up the performance, right? Up or down by 2 times, 3 times the performance amount. So let's say you lever it against the S&P and say that it's a 2x levered and the S&P is up 10%, you're expected to get 20% up. And the flip side, though, is if the S&P is down 10%, like we've experienced, very recently, probably more than 10%, you're down 20% because the leverage in it has a multiplication factor to it, right? So the ETF manager uses derivatives to let's say you have $100 invested, he uses derivatives to get that $100 to $200 or $300 based on what the underlying S&P index is doing.
Interesting. Okay. So the issue with these, for clarity and why we email clients and say, hey, don't buy this thing. So these are specifically designed, if somebody were to purchase these are specifically designed to not be held overnight and to be only used for what's called momentum trading. So if the market's going one direction, say during that day, and you're trying to leverage with or against that direction. And it actually says this right in the prospectus of the fund. I know that no one reads these. This is typically what we'll do is we'll pull up the prospectus of the fund that somebody owns, and we'll highlight the section that specifically says these are not designed for long-term ownership. These are not designed to be held overnight. and they're strictly just designed to, to lever that specific trade. Here's the issue. So you have diminishing returns in a normal market when held for a period of time that's longer than a day. Take, for example, you buy a 2x S&P 500 fund. And let's say that the S&P is down 25%. So in a normal market, let's say you just buy the normal Vanguard S&P fund, right? S&P is down 25%. You need approximately 33% positive to get right back to zero. So just the math. 25% down, 33% up to get back to zero. If you buy the 2X ETF that's 2Xing the S&P, instead of dropping by 25%, you'll drop by 50%, double. But now when you drop by 50%, you need 100% to get back up to where you were. $100 in goes to $50. I need to get $50 back, or 100% return to get back to my $100. But here's the problem. 2x a 33% rate of return, remember from my prior example, is only 66%. And so the issue here is that when markets are volatile and you are double levering, you end up sort of petering out towards the low side. Remember, you can go down 100%, not more, but you can go up a lot more than 100%, which is why these mathematically don't work for longer term trading. So that's why we never recommend, and well, we never recommend that people buy these anyways. But if you do, we never recommend you hold them. And that's also why it says that right in the prospectus, to not hold these for a long-term investment.
Yeah, and we're also not recommending day trading as well. So that's probably that's probably the only scenario you could use or should use any of these. If you have, for sure knowledge or a good hunch that the market is going to continue to run up or run down, because these levered ETFs work in reverse too. There's called inverse levered ETFs, so you're betting on the market to go down, which we've seen held in client portfolios that come over to us, held for more than one day, which is never recommended.
Yeah, so these work both ways. You could double lever the market negative, or oil negative, or these types of things. These things exist for almost anything these days. Let's switch over to active ETFs. So I think a lot of people assume that ETFs are passive. At least that's what we're told by Vanguard ads. Passive meaning, it's not actively managed, but there's sort of a newer invention that is active ETFs. Let's talk about that for a minute.
Yeah, we actually are seeing quite a bit of old mutual funds move from the mutual fund, what we call in the business wrapper, to the same strategy and manager, using not the mutual fund wrapper, but now an ETF wrapper. So it's the same fund, same management, same strategy, but with a different, tax shield essentially, or a tax approach to investing. And I think that's what we're seeing initially with active ETFs. And again, we have some newcomers like ARK and Kathy Wood, who just started out. Well, she did start out as a mutual fund. Actually, I correct myself, but she gained a lot of notoriety through the ETF. So that's one way. Another way through active ETF is, you can buy, trade, and sell as if you were trading in a mutual fund, like I mentioned before, but now they're just coming out fresh out of the gate as a brand new offering. And you're going to get all different flavors. We use them too, because they are more tax efficient. The expenses tend to be lower, but they're in the same neighborhood as an active mutual fund, which on that side, to be fair to them, their expenses have been coming down as well. So it's really how you want to approach it. And we've mentioned that ETFs are more tax efficient, meaning they don't typically kick out a capital gains distribution. And that's what you're going to get from active ETFs. So any straying from the underlying benchmark, you're making an active bet, right? Whether you realize it or not. So it doesn't take much to be active, right? Let's say you want growth, right? You want growth companies. You're making an active bet relative to the benchmark.
I think that's such a good distinction, right? Because I think most people think that they're being passive if they're buying an ETF, but passive really by definition is you're buying a passive index fund which would be like an S&P 500 fund or a Dow Jones fund, for example. But if you're buying a S&P 500 growth fund, technically you're making an active bet against the market because you're different than the market there. And on top of that, when these funds are then traded, you know, if somebody is buying and selling, or they're selling the growth fund to buy the value fund, or they're buying a healthcare fund or whatever, that is again an active move. And so I think there's a disconnect with the ads just say buy passive, it's cheaper equals better. And that's not necessarily true. Active funds can be more expensive. The cheapest funds are like the S&P funds, you know, they're maybe 0.03% to own. Active funds are more, smaller funds are more, and also actively trading, which almost everybody does. I'm not talking day trading, I'm just talking trading, period. Those are all active moves with or against the market.
Correct. And, you know, Vanguard does have, you know, quite a few active fund offerings, right? They have 379 funds, 128 of them are active, right? And in combination of mutual funds and active ETFs. So Vanguard, you know, who we do use in our models or portfolios, they do have a extensive active background, you know, outside of what the bogleheads like to tout. It's you gotta be careful about what you're buying and know what you're buying, because certain passive ETFs, they're going to follow different benchmarks, right? We look at small cap versus small cap. One is the benchmark against the Russell 2000. Another one is the benchmark against the S&P 600 small cap. They have very different makeups.
Very different.
Yeah, Chris mentions passive benchmark ETFs following the benchmark. So when the S&P kicks out a company and adds another one in, yes, you'll pick that up, right? You'll get that as it comes in if you own the S&P index. But certain benchmarks have different rules about reconstituting and when to kick in and kick out, right? Everyone knows GameStop and AMC, and not a lot of people know that they owned it in their small cap funds, and they owned it for the majority of the year because certain funds only rebalance once a year.
Yep. Know what you own. That was our theme last time, and we're carrying it over to this time. Know what you own. Let's spend just a minute or two on these defined outcome ETFs, because these are a new thing and they're probably floating up to, you know, getting in front of our clients to, you know, they're probably getting marketed to buy these things. So let's spend a minute describing them, and then we'll move into our 2022 and 2023 commentary.
Yeah, the ones I want to point out that probably clients should stay away from are the big marketed ones that say, hey, if you have Tesla stock, we have a solution for you, right? And I think the big thing is watch out for marketing that really over promises and under delivers. And I think this is what you'll get. This is a form of derivative trading as well, because they use options to cap the upside and, you know, limit the potential downside. So defined outcome means your defined outcome in the future is expected to be no more than 10% down and no more than 15% up. So now stock investors have, you know, a pretty much a strong expectation of what their particular stock holding would have, but they use options to do that. So it's the way I explain it is confusing. I think that's probably why retail investors should not invest in something like this without professional advice or guidance here. But, you know, certain situations might benefit from this, but it's not many, to be clear.
So do these all have capped downside in exchange for capped upside?
Yeah, that's how the capped downside is basically a form of insurance, right? Who's going to pay for that? Or who's going to give you that for free? You got to pay for it. Right. And to pay for that, you do give up some of your upside. But like I said, that limits your upside. So let's say you did buy a bunch of these when the market was down 25% in July, and the market rebounded 7% at the end of the year, right? You most likely did not participate on the upside if you bought a product like this. So basically, if you ride the bottom and then now decide, I want this, it's too late, because all you're doing is limiting upside. You got to be careful when you're using really anything like this. You got to know what you're investing in.
Yeah. Know what you own. Back to the theme. Yeah, there's some decent research on these types of products, and this I guess flavor has shown up in investment products, more commonly in insurance products as well. And this concept of limiting or guaranteeing a minimum return and then providing some upside but capping upside, depending on how it's structured over market cycles, because you gave up those largest return years, you actually end up earning significantly less. And so these have to do with kind of perfect timing in specific situations where they would work out in someone's best interest.
Yep.
So I guess our message here would be, don't take the bait, because you're concerned of limiting downside in order to get a specific amount of upside. What generates sound long-term investment returns are those one-off years that do really, really well, which are always unexpected. That could be this year. It would be unexpected, but it could be this year.
Yeah. Yeah, and that's why these products appeal, because especially after a downturn that we experienced last year, it's just because it hits that emotional side, and just the data shows longer term that you're just giving away money. Yeah.
Okay, interesting. I'm sure these will come up in the future, because as these products roll out, we get questions about them, and we start analyzing them and determine, if any client should have this, and if so, in what way in their portfolio. So this will probably continue to come up for us. All right, let's shift gears. 2022. Let's give a quick year in review. What did we think happened? What didn't happen? And I'll let you kick us off here.
Yeah, thanks. I'll kind of get into because we try to look forward. So I'll give you a glimpse on what our thinking is heading into the 2022, because it'd be easy just to go look in hindsight. It's like, well, Russia was obviously going to invade Ukraine, right?
Yeah. Of course, oil would go up 60%. Yeah, we traded that, sure.
Our general approach isn't to swing, so significantly one way or another. So if you are, in those cases, you are wrong, because we are predicting the future here. Any wrong assumptions don't blow up the performance of the portfolio. Mm-hmm. So heading into 2022, a lot of 2021 actually colored our thinking. 2021 began the year where these high-tech growth names, first and foremost, started dropping. I mentioned Cathie Wood. ARK was the poster child of that, of February 2021, where it peaked, and then it had a very dismal 2021, right? And then other growth names followed. That's because what sparked that is the assumption of the Fed back in 2021 saying they are very soon, going to raise rates, right? Because inflation is creeping up, hasn't crept up yet. They use the term transitory. They said the economy has not fully recovered. So they were hesitant to raise rates, but they were looking at very soon. This caused the market to look ahead and reward value stocks and punish growth stocks, right? What we didn't get, though, by the end of the year was growth stocks recovered and actually beat value stocks. But that kind of showed us what higher rates and the market reaction to higher rates was. And that's what we brought into 2022, where we started balancing out value. And just so everyone knows, a passive S&P index or a mid-cap index or small cap index, they actually all tilt towards growth. So if you bought 100% S&P, you actually have more growth allocation or more growth percentage in your portfolio than value.
Why is that?
Apple, Amazon, Tesla.
Big companies.
Yeah, you're holding the biggest companies that are all growth type of companies. And by, natural state of things, the index is going to pick up all those mega caps, right? Apple was $2 trillion. I say was. Amazon was $2 trillion. Tesla, right? So these guys still make up the majority of a passive index. So if you just buy passively, you're going growth. That's it's like a 60-40 split. It's not even close. So we tried to make it more of a 50-50 split by picking up value names. Specifically, we looked at regional banks because we knew rates were going to go up. We didn't think they'd go up to this rate this fast, but banks benefit, right? If I'm loaning out money, I'm going to get higher interest rates. That's good for a bank. But what we didn't forecast for was a possible risk of recession that we're currently in right now. So that's going to dovetail in 2023 predictions. But yeah, we believed in 2021 making our portfolio decisions in 2022 that inflation was transitory. I know that's such a bad word now, but we thought inflation was driven by supply chains and, semiconductor shortages that will improve. And we thought anyone who wanted a washer dryer was going to be able to get one. Yes, actually turned out to be true. What we missed was everyone wanted to go on vacation. Everyone wanted to get out of their house. Everyone wanted to leave the country, go to Disneyland. I know the prices at Disneyland have gone up twofold, threefold, and the parks are still jam-packed. So it was ultimately a demand issue where we injected way too much stimulus into the system, where people have way too much discretionary spending. And they, to be fair, they're not saving. And we have data to show that the savings rate, in the U.S. has dropped, nearly to zero.
Significantly, yeah.
So, again, it's a problem of impulse spending or consumption, not supply chain anymore. Supply chain, go look for a TV online. You could find one really cheap. And while we're right about that, we were wrong about services.
People just kept spending. That was the interesting part, right? Yeah, spending will dry up at some point. It didn't.
Yeah,
it didn't at all. It just kept
the whole
going.
Southwest debacle last week, where we had record number of travelers stranded for the holidays, trying to get back home or trying to see their loved ones. And I think services might be the harder issue to solve for because we have a labor crunch, meaning we don't have people who are willing to work, whether early retirees or young YouTubers who are unwilling to do some of the entry level work that's required in these service industries.
You know that kids right now, the number one job in America that kids want is to be an influencer.
Yeah, it's easy money, right?
That's not good. Hopefully that fixes. If we do fall into recession, maybe that'll help these kids change from being influencers to something else.
But, yeah.
I want to comment quickly on the bank trade. So you said a lot there, and I just want to unpack one or two things. So when we do make a slight pivot or tilt in the portfolio, we do this at what we would call a satellite level. So think of it as a core and a satellite. Your core strategy,
if it goes to zero, it won't blow you up.
Totally. Yeah. Your core strategy are all of the things that you think would be in the portfolio. The S&P's in there, and mid-sized companies, and small, and some international, and some bonds, and all this stuff, right? That's always going to be in there. You're never going to see us completely sell out of U.S. stocks and go put all the money into China, emerging Brazilian tech companies. We're not going to do that. And so when we make a trade like this, it's in this satellite space. Now, you mentioned banks. We, for really much of the last decade, have leaned a little bit heavier into growth and growthy type things. Historically speaking, when interest rates are very low, that provides a tailwind to growth companies, and they tend to do well. And so when we came into 2022 with the prospect of rates going up, we wanted to slightly rotate away from that and come back to a little bit more of a neutral stance. To your point, how we still lean a little bit growth because just buying the S&P leans growth, period. But we also had some satellite positions in some more disruptive tech and some other, unprofitable, clean energy type things, right? And various things like that is where we said, okay, what is our highest risk stuff for if interest rates go up? And we didn't think that rates would go up so much so fast. And that really caused growth stocks, as everyone knows now, to really come down. And so those are the positions that we ultimately rotated out of. We're talking, a tiny percent of portfolios into more regional banks, saying, well, higher rates benefit banks. And then we actually later rotated out of that position because the risk of recession started to come up. Remember, spending, when it hit the news, we're in recession because of 2 negative growth quarters of GDP, but then it hit the news, no, we're not in recession. Why? Well, what's the definition of recession? Well, the labor market has to blow up. Jobs remain very, very strong, and spending remained very, very strong. And so as the risk of recession started to increase, we said, okay, recessions are not good for banks. Even in higher interest rate environments, there's less lending. Let's rotate out of this position. And we shifted more into value companies, more dividend paying companies, because they have very strong balance sheets and tend to be able to control pricing power better than, say, growth or tech companies. The example I would leave with you there is that if Walmart is raising the prices of back to school products, so is Target. And they both can control that pricing power, and people will pay those prices because they're in almost direct competition with one another.
Yeah.
Versus if I'm Microsoft, I can't really raise the price of Azure because I've got direct competition with AWS. And tech is inherently deflationary. And so tech generally doesn't have as good of pricing power in inflationary environments.
Yep. And that leads us into 2023. So again, after all the predictions of 2022, given lessons of 2021, really, we don't just look at history blindly. Oh, well, the 70s did this, right? The 80s did this. We're going to invest like this. It does
right.
That history.
This worked then, so it'll work now.
Yeah, history doesn't repeat itself beat for beat, but it rhymes sometimes, right? So we kind of use it as context, and then use recent developments to color where our outlooks go, right? Because outlooks ultimately tell us where to shift certain parts of the portfolio or not. Mm-hmm. So 2023 predictions sure to be wrong, because we don't know what the future is going to hold. There might be another invasion for all we know. And not to make light of that, but those are things we just can't account for because it doesn't exist in our world yet, right? And right now what we know, though, the Fed will pause, not pivot. And I think that's important. Pivot means the Fed will raise rates to 4.5%, 5%, and then cut them once they get the recession. I don't think we're ever seeing that in tea leaves. We're not seeing the forecast or the Fed speak. And the Fed members have been very, very public in the last, 6 months. Mm-hmm. And they've been very loud about keeping rates high and not cutting rates and destroying inflation. So the fact that we're seeing pricing for the future interest rates coming down so quickly, I think that's a mistake. And I think that's a little bit too wishful thinking, but it kind of gives too much credit to the Fed that they can, charge up interest rates and give us the recession when we want it. I don't think recessions work like that. One, the labor market, as Chris mentioned, is 3.5% now because we've got a very strong jobs number. Yeah. People are still hiring, and I don't think that goes away so quickly. The next point is the Eurozone. Europe will go into recession officially by Q2. These things take time, but if you ask anyone in Europe, I think they feel they're in recession now. Gas prices are still expensive for them. A lot of people don't realize this. Gas prices are pegged to the U.S. dollar. What's the U.S. dollar done in the last 6 months?
Super strong.
Yeah, and our gas prices are per barrel is $74. That's because of the dollar has gone up. So if you're buying those $74 in oil using euros or pounds or yen or a different currency, you're paying just as much 6 months ago, if not more at this point, because you have to convert those currencies into U.S. dollars. So from my point of view, Chris's point of view, gas looks cheaper. It isn't. It's not cheaper. We're seeing some demand erosion across the world, but gas prices are still high for the European zone. All right. And then the next one, China. I guess no surprise here. I think they're going to stumble reopening. Again, not to get political here. I think the lack of vaccine access to their country has created issues, right? Their hospitals are going to pile up, if not already, and the death count is going to rise simply because they did not want to use the Western mRNA vaccines that have obviously been so effective for really not just our country, but every other country that uses it. So
you think it'll sputter? They'll still kind of start, stop, and then it'll be a slow reopening.
Unfortunately, that's how the government is. We've seen some real extreme cases here in the last few months where, they're locking entire cities down, right? And, severe punishment for breaking these quarantine rules. And this one probably is the biggest one that I go out on a limb on is growth stocks will win the year. We still have a pretty balanced tilt, growth versus value, but I'm talking about quality growth. Chris mentioned the Microsofts and Amazons of the world. These companies make money, right? They're not Peloton, or they're not GameStop. These guys, even if they don't have quite the pricing power, they still make a hefty amount of margin, and I think they can still maintain that. And the next two, housing will correct, not crash, with mortgage rates touching 7%. I think housing will still come down a little bit, but it's not the crash that we were expecting like 2008. Supply is still a big issue. We're having people who thought about selling no longer selling because what are they going to do? Where are they going to live? And I think that's going to be the biggest issue is if you're paying 2% mortgage rates, right? Why would you jump into a 7%? Even if you could afford to upgrade, it just doesn't make sense for a lot of current homeowners to sell and then move up. And then the next one is inflation will come down to 3% year over year. And again, we could debate the measurement here, but that's CPI, which has come down recently to 7.1%. But I think it'll end the year at 3% next year. And PCE, which is the one we look at, is 2.5% year over year. That's normally a lower one because people shop around.
And I mean, really, it's just year over year numbers catching up with those month over month numbers that we talked about last time, because month over month actually looks pretty good, currently about 3.6%. So each month that goes by, we get another low data point to erase a high data point, and it comes down. So all of that is promising.
Yeah, because right now, January's data is going to be compared to January 2022. Mm-hmm. So prices are still going to be higher, but they're going to be compared to a higher number the previous year. So it's going to look like inflation's coming down, but prices are still, the level of price is still going to be much higher than what we're comfortable with. And we might see some deflation, especially in cars, I think.
Started.
Yeah, used car loan rates is 10%. So who's buying cars still? There obviously
it's
are.
10%?
10% for used cars, yeah. So
that happened quick.
By design, though, people are buying less used cars because they can't afford it. And
Mine's
that's what the Fed is trying to do.
4.25, I think. 4.3, something like that. And that was not that long ago. That happened fast.
Yeah. But again, some car dealers are, for new cars, they're buying bulk loan amounts, and then they can offer some of these promotional rates at like 2.9%, 3.9%, which seems more palatable.
Right.
But the used car market is, looking at the Manheim Used Car Index, it's cratering.
What about bonds? What do you think is going to happen with bonds?
Bonds are going to be the winning asset class.
That's bold.
Yeah. Heading into 2022, we had 1% yields. Now we're looking at 4.5% on the short end, like short yields, and 3.5% for 10-year, like intermediate yields. The 70s, right? That's where they started. And when Paul Volcker raised rates to 20%, bonds lost 9% that whole year. It's simply because bonds had a starting rate of 4.5%, which is a much healthier rate than what we had last year.
And here's a fun fact. Bonds have never lost money 3 years in a row. They were negative in 2021. They were negative in 2022, 2023. Could we break a record? Of course we could, but they've never been negative 3 years in a row. And they've only lost money 2 years in a row twice since 1926. So I had been saying a lot on my calls, we were living through the 100-year worst start, actually now finish in the bond market. We did it. We finished it. And now we're in 2023. So it's likely that bonds are positive in 2023.
If you do get a recession, U.S. or really anywhere, that money's going to flow into U.S. debt. And that's going to bring interest rates on our intermediate and down, even if the Fed's raising rates. And that's what's called an inverted yield curve. We'll get into that, but
we'll get into that.
That's what's showing up in our data right now is an inversion. So there is a rush to safety at this very moment.
Yeah, that's interesting. Okay, maybe we can unpack that more next time.
Yeah.
That's awesome. Okay, good. Hey, thanks. That was rapid fire. Let's if there's any questions out there, let us know and we can unpack more of this stuff. But that's all the time we have for today.
All right. Thank you, everyone.
Thanks so much.